All right, so we've spent the morning talking about security tokens, which to me is interesting, but it's kind of applying an old paradigm to a new paradigm. And to me, I'm most excited about the real crypto native stuff. And so that's what we're going to talk about on this panel. In the past, about 18 months, I was looking at the data recently, and there's been 103 projects that have raised over 30 million in a token sale pre-product. Now, this is unprecedented in the history of fundraising, right? If you look at the last 10 years of venture capital combined, you can count on one hand the number of 30 million plus pre-product sales. And so I think this can be both a good thing and a bad thing. It can be a good thing because it can enable ambitious projects that may never have been built before to exist, which is super exciting. But it could also be a bad thing because low-quality projects that have no business raising that much money end up raising money and never delivering a product. And unfortunately, I think of the 103 that I mentioned, the majority are closer to bad than good. But on this panel, we've got the founders of 4 projects that have all done token sales and gotten to mainnet launch, or in one case, very close to it. And we're going to talk about kind of the learnings along the way and how they got there. And why don't we first start by you guys talking a little bit about your project and why a token sale made sense. And maybe Andy, you can start.
Hi. So my project is called Maker, or MakerDAO, and we seek to create a stable coin. That's a cryptocurrency that's stable relative to fiat currencies. It's a very simple system. Our stable coin is called DAI, D-A-I, and it is an asset-backed hard currency. That means that every DAI in circulation is backed by some sort of valuable asset. And the way that this works, to put it briefly, is that anybody in the world can take their valuable assets, lock them up in our smart contract system as collateral, and then issue DAI against them. Later, if they want to retrieve their collateral, they simply return the DAI that they issued, plus a small fee based on how long it was outstanding. And then what we're going to talk a little bit more about today is a second token called MKR, which administers this system and, broadly speaking, makes decisions about which types of assets can be used as collateral in the smart contract system.
And maybe just quickly, of these, I think you guys were kind of the most non-traditional in how you did your token sale, and kind of why. So maybe just briefly talk about that.
Yeah, so I'm sure we're going to get more into this, but Maker is one of the oldest projects on the Ethereum blockchain. It actually started before Ethereum even launched. So there was no ERC20, there was no tradition of ICOs, there wasn't even a blockchain. So we had to start very small, building organic interest and sort of allowing people to come to us and build a relationship in our community before tokens were sold. And they've been sold continuously since 2015 up until today, basically as we need to raise funds. So we'll get a little bit more into how that worked later.
So there was no token sale or ICO or anything like that?
There was no Bonanza one-time event, basically.
Okay. Brendan, why don't you talk a little bit about BAT and Brave?
Sure. So Brave looks like a browser, but what we're really building is a eventually decentralized platform for funding the web as we know it. Funding the web requires donations, subscriptions, and for better and worse, advertising. With over 80 billion spent on digital ads in the US last year, and a stunning amount of fraud. A professor at NYC says over 16 billion in fraud. So we start with Brave by blocking all the tracking and privacy invading JavaScript, my creation from 1995, that advertising utterly depends on, because it's become a massive privacy problem, as we can see in the news every day. It's become a conveyor belt for malware and, of course, fraud on the other side, 16 billion that's taken from marketers spending on fake human bots. But if we block everything, we're notionally hurting the publishers who are at the end of a very long payment chain. So we wanted to reconnect users and advertisers, if users opt into advertising, it has to be consent-based, and publishers. And that means reconnecting the payment flow, and that means crypto. There's really no good way to do it with fiat. So we started with Bitcoin, and we realized it was lacking two properties. At the time, it was getting very expensive and slow. It got better after we did the basic attention token, but we also wanted to do an idea that I had in 2015 when I met the Ethereum team in London, which I called Bravecoin at the time, and that became the basic attention token. And the idea was to pre-create a bunch of tokens to give to users, a social credit pool. We call it the user growth pool. And that's the real reason we did the token sale, I think. It funded the project, of course, but it also helped us create, before the sale, a bunch of tokens, not for sale, that float with the SOL tokens that can be given to users, given to creators on YouTube who refer new users, help build the platform.
Got it. Julian, why don't you talk a little bit about Golem and kind of specifically why a token sale made sense?
Sure. So Golem is a market for computing power in a sharing economy model. So you can rent out your computer to others or rent others' computers if you need additional computing power. So it can be like referred as Airbnb for computers. We are live on Ethereum Mainnet with our beta since April. And what you do now with Golem is CGI rendering. So basically you can do an animation on other people's computers, pay them for that, collect results. If you want to see demo, we are in an exhibition area. And obviously, Golem Network token is medium of exchange token, probably with some other features in the future. And because of that, I believe that that model makes sense, because if one of the properties of the token is medium of exchange token, then obviously I think you need two properties for token to make sense. Like first one is, obviously you have to have like a natural market, so not like a first in marketplace, but a natural marketplace, and this is obviously a case for Golem. And the second property is that there is also like a natural network effect, which is also like obviously true for Golem. Like the Golem, the better is, the more user it has. Like both sides, like demand and supply. As for executing, how we funded the project, we are one of the early projects, maybe not as early as Maker or Eich or some other projects that like launch the tokens like around the launch of Ethereum. Yet the concept dates back to the early days of Ethereum. Like we had like a first presentation of concept on DEFCON 0, so like pretty early days, and we generated token and did the crowdfunding only 2 years later. So I think this is a little bit like different to what I could see on some conference over the past 3 days, where people are coming and hey, we are doing an ICO. So like to me it is like a doing project, and only like this is the way of funding it. Mm-hmm. and obviously not a goal in itself. And I think that was exactly like that, like a few years back. I'm not sure this is like that, like at least not in 100% of the cases now, which is a little bit depressing.
Got it.
Yeah, so I think that's it for now.
Got it. And Jay, why don't you talk a little bit about Cosmos and why a token and the Atom token made sense in the case of Cosmos?
Hi, I'm Jay Kwon, and I'm with the Cosmos project. Cosmos is an internet or a network of blockchains, and so it starts with proof of stake. So I'll talk about how we started. And so Tendermint is a project that started in 2014 as a way to replace proof of work with a better consensus algorithm, arguably, that requires no proof of work and just requires public key cryptography and well-constructed algorithm, two-phase commit algorithm. So Tendermint draws from like decades of research into BFT algorithms that had happened even before Bitcoin came around in 2008, right? So around 2013, I saw some projections about the cost of proof of work, and I realized after some napkin calculations that if Bitcoin continues to grow, at the rate that it's doing so, then the energy consumption of Bitcoin would be so significant that we would need alternatives. And besides, I wanted to live in a world where we could support more than a single blockchain. So I love Bitcoin, but I also like Bitcoin Cash. I like that there's all these choices out there, and I believe, and we believe, that the future of blockchains is about connecting many disparate many different blockchains with their own ideas together and making it interoperate. So, starting with Tendermint, we figured out a solution that allows blockchains to communicate with each other directly, as if one blockchain might, like Bitcoin, as if it were aware of Ethereum and the latest consensus state of Ethereum. And using this technique, we can create a web of blockchains that connect to each other and communicate to each other securely, almost as if they were connected through the internet, like with TCP/IP, except virtual packets and using Merkle proofs and like client SPV proofs between these blockchains. So that's Tendermint, and Cosmos. We haven't launched yet. We're launching very soon. So this has been a long journey over the past 4 years starting with Tendermint, which was really supposed to be a proof-of-stake blockchain to begin with, and then late 2015, when private blockchains started to come about and consortium chains, we were like, okay, wait, here's a legitimate and legal way to raise funds, and because the private blockchain is a real space. So we took Tendermint and kind of made it agnostic, took out the consensus engine and tried to pitch to VCs everywhere, all the blockchain knowledgeable VCs, about creating a proof-of-stake validation as a service business. Hey, Joseph. And we couldn't get any funding because the VCs, even though they were knowledgeable in the blockchain space at the time, this was 2016, 2015, they didn't know much about proof-of-stake. So for sure, the crypto community knew much more, and they were more interested in, because of course it's the entire world, right? And anyone who's interested in this stuff can read about open source and what's going on, whereas VCs are a select group of people. So after we failed to raise funding with our idea, we went back to our original idea and said, let's just do a fundraiser and see how that goes. We raised, at the time, this is before the ICO wave, and we raised $17 million in 30 minutes. And we had no idea that would happen. So we started the fundraiser, we didn't know how much we'd raise, and it was all sold out in 30 minutes. So I think it's a great proof of the power of blockchain systems and fundraisers in general.
That's a really good point, and I was actually just going to get into that, right? Which is, it's an interesting dynamic, because I see you guys as kind of four pure projects that did token sales before blockchains and tokens were really hot, right? And I think it might be the case for all of you that traditional venture capitalists at the time just weren't interested in supporting these projects, right? And the kind of ironic thing about what we're seeing now is there's, the space is really hot right now, right? And there's billion-dollar crypto funds that are putting tens of millions or hundreds of millions of dollars into these projects. And it's unclear how that will play out, in my view, because part of the token sale is getting buy-in from a broad kind of global user base, right? And so I'm curious for you guys, how do you think, having kind of done token sales really before they were hot, how do you think about what we're seeing now kind of in the market in a number of these, $10 or $100 million token sales that are being done mostly by funds?
It's extremely difficult to, it's an extremely difficult problem to solve, especially now that the genie's kind of out of the bottle, because it sort of is dependent on this proof of individuality problem that exists in the wider blockchain space, right? So we had it very lucky early on because there weren't gigantic funds that could snap up all the tokens in 30 seconds, right? That was, that's the big problem that we see in ICOs, is especially with capped ICOs, everything is just gone like that, right? So the way that we did this was it ended up functioning a little bit like a CAPTCHA almost, where we made it a little bit harder to get the token, right? We didn't rush out and tell everybody, drop everything and buy this. We kind of put out the information that would entice somebody who's truly interested in this technology to come and learn more and join our community. And then, and only then, does a token sale or does purchasing a token appear attractive or even possible to them, right? So what we did was put in basically some sort of filter that allowed us to get a much wider group of people than we would have otherwise, basically by making it about the technology first and the token sale second. Although it was incredibly necessary, it wasn't like the reason that we were having a conversation. The reason we were having a conversation was to create a price-stable cryptocurrency, DAI.
So we were inspired by Golem, but we were after ERC20. And when I visited Ethereum London in July of 2015, when I was thinking of Bravecoin, Stefan Twall gave me some smart contract code and said, you could use something like this. And I set it aside because I had to found Brave and do the browser first. But then after the DAO attack, I looked at that code that had the same reentrancy problem. So we not only were inspired by Golem in its success, but also in its simplicity, and we kept our contract super simple, which means we did a capped sale. And of course, people said, I'm a minnow, the whales will take it all. What about me? And I said, okay, I'll raise the cap. And then they said, no, you'll dilute me. There's no good solution. This is Vitalik's first dilemma that he blogged about after I trolled him on Twitter. Other sales have tried, after us, tried interesting techniques, some kind of address whitelisting with quotas. These all can be worked around as far as I can tell, and they all add complexity and risk. And I didn't want to have any unnecessary risk in the smart contract. So we did it direct. And I think the only thing I would do differently is I would have raised the cap to let more people in, because we obviously benchmarked much larger sales that followed on our heels.
How much do you think you would raise if you did? You obviously, kind of before the boom, raised around 30 million in 30 seconds. How much?
6 million.
36.
2 blocks.
How much, if you did a token sale today, do you think you would raise?
I have no time to think about it, but even then, I think we could have just made the cap, 5x and sold out.
So do you guys have any thoughts? We can move on to the next question if you don't, but any thoughts on kind of just the massive fundings we've seen by token sale projects relative to kind of when you guys got involved?
Yeah, so like, maybe I'll take both questions.
Yeah.
So like we did, our crowdfunding is super simple, and that was always the assumption, like for a number of reasons, but security being one of them. Second, the cap was like a direct, like the cap like was the result of two things. Like first, like we didn't, we consider like the crowdfunding money not revenue, but a liability in fact. So you don't really want to have like it to be liability. So you should limit that up to the needs. But on the other hand, like also that was exactly after like a month after the DAO, and there was like a kind of, I don't know, like a rule or commitment, or at least like a belief that people should not put like too much Ether in a single contract. So that made like also sense to limit because of exactly the security reason. As the pretty valuations right now, yeah. Well, on the one hand, this is great that the space, that the industry is well funded. That gives us like a capacity that we wouldn't have otherwise. Also, like although our cap in USD obviously like, was very small compared to what was later. Like we obviously raised Ether. So yeah. But overall, I think that some modesty here would be helpful.
Okay. I just wanted to add that I'm so glad that we did our fundraising way back then, because nowadays, right? Like if you want, when you do a public fundraiser, it's probably because your project benefits from a massive distribution of tokens. So, but if you want to open that up, then like there's too much money piling in, and you don't want to raise too much, because then you have there's essentially liabilities. If you deliver a project and it doesn't do much better than what people expect, even if you tell everyone it's not a security, it's not an investment, please don't try to make money off of this. People will still do that, and they can always sue you, right? Especially in the United States. I think what we need is like a way to do fundraising so that anyone can pour their money in, but ultimately at the end of it you calculate, oh, of all the people, here's the ratio, but we're only going to take 20 million, whatever we need, $10 million to make this succeed, and then return everything else maybe after some unbonding or unlocking period. Maybe that's the solution. It still gets you that distribution you need.
Yep, I agree. I think one of the big learnings over the past year, as you said, is when you do a capped sale, and I think Brave may have had this issue where you have huge whales that take down the round. And there's ways, I think there are some best practices, like what 0x did with basically putting a cap on every individual.
Every address.
Every individual address.
It might be one individual using multiple addresses.
Yes. But have you guys seen any other kind of best practices related to that, or is there any learnings that you've had, Brendan, in kind of your execution?
Well, first, we had 84 addresses by the sale very fast, but the current Etherscan chart shows over 62,000 addresses, and we think it's just diffused through speculative trading. So we don't think there's a huge monopoly. If you look at the biggest accounts, it's our user growth pool, which was in my opinion, our main motivation for doing it, and the Bittrex liquidity pool, they bought into the sale. So I just wanted to say it wasn't all whales, it wasn't all sort of the 80% going to the 1%. But I do like the evolution that's happened since then. 0x and others have tried various whitelisting approaches and quotas. It would be nice to have something like Vitalik alluded to in his blog post that is more standardized.
So you guys, again, I mentioned at the beginning, there's been hundreds of projects that have raised massive funding, and I think the reality is maybe a handful have actually shipped a product. And I think there is a realization that there are a lot of challenges associated with it, particularly raising a lot of funding from people around the world and and managing that community. And so I'm curious for you guys, can you talk about any challenges that you had with that? Particularly, Brendan, I know you've raised venture capital before. Like, how does managing a community who has a vested interest in your project different than kind of managing traditional institutional investors or VCs?
So we built for utility, and we did not cross the streams at all between security and utility. We took no chances. We didn't give any BAT to investors or pre-sell it. We didn't pay exchanges to list. And we've been super clean about that because we do view it as a utility. And I do see it now being acquired for buying ad space for utility on the platform, since we have had the BAT integrated since last fall. But the VC investors, and we love our investors, were a little surprised, right? This was the new world. And I think they wondered, are we chopped liver? What are we, Or some of them were like, where's my BAT? And we said, sorry, we're not going to cross the streams. So there was a little bit of learning there, I would say. It wasn't unpleasant, except maybe in one case, and that investor wasn't a big one. But they got over it. And I think if you look around Silicon Valley, I know a bunch of VC funds that are building token portfolios. So it's the new world.
I think that I've learned a lot about online communities, especially early online communities in the last few years, seeing them appear at multiple levels in my project, in Ethereum, and in the wider blockchain space. And I think that one of the most important things that is of course true for any community, but especially true with an online community where you're communicating mostly through text, it's just setting cultural norms early on, especially cultural norms around how you communicate, at what level that you communicate, and what are the rules for how you relate to each other. So to me, it's almost counterintuitive to people who think in terms of like blockchains and dApps and kind of like rational, self-interested actors and stuff, but really I think it's a social problem. It's just, is the leadership good? Are they role models? Like, are the people who are driving the project forward people that you want to emulate and be like? And do they create like an open, accessible, sort of welcoming community, right? And so that's what we've tried to do in Maker, and especially we've done that by keeping the focus, like I said, really, really on the technology and the product that we're delivering, and much less on just like short-termism, basically. So to me, it's one of those social problems that often get ignored in the blockchain space.
Maybe Jay, you could talk a little bit about this, because I know at Cosmos, you guys think community is really important, but at the same time, you're not, you haven't aggressively marketed it and things like that. So talk a little bit about what it means to now have this community of token holders and how you guys think about kind of the benefits and the challenges with that.
Okay, so maybe one thing that we learned is that development always takes a little longer than you think it would. And the way we did it, the people getting the tokens from the fundraiser, they're not going to get it until we launch the blockchain, which is happening soon, but it was a year ago when we did a fundraiser. So while there were many people who contributed, almost 1,000 contributions, and most of them individuals, they're all waiting for the launch to happen. Because there's no trading token, it's hard to really expand our community. So having liquidity of the token, while it also makes it regulatorily, I think, trickier, is also really important. So we're trying to get our blockchain to launch as soon as possible. And the other thing is, I think it's really important to note that we didn't go out and try to get all the token investment that we could. I think what we learned, maybe the biggest lesson that we learned, especially with the success of our fundraiser and where we are today, is that when you focus on solving real problems and just focus on evangelizing the technology, that is, if you do it right, that should be sufficient to get traction in the community and reputation, such that that reputation and your leadership, as an organization, just naturally creates gossip and more awareness, and that was sufficient for us. So I think for sure, don't try to market your token or your product to people who are just trying to be speculators. I'd say ignore the speculators as much as you can, because they don't seem to help at all.
All right.
In our case, anyways.
I'd like to keep this conversation going, but unfortunately we're out of time, so thank you guys very much.